Hello, this is Jong Yu again. Actually, as I indicated in the email, or maybe all of you haven't been able to see it, but I just sent out the email that I would like to cover the remaining part of my previous presentation at Hanoi. And this one is actually, I have already mentioned it for IFRS 17, so and you already have PDF version and also the component structure and level of aggregation and contract boundary, and I just added one more small picture of it. So once we separate some of the distinct different component, we use IFRS 9 for the investment related component, IFRS 9, and service component for IFRS 15. And I just want to add to it. And I also cover briefly in IFRS 17, there is a measurement approach that is suggested, and people just call it because of its, like features that is provided in the standards. It is called building block approach, right? It's like a Lego. It is not, like a deeply related internally. So, for example, risk adjusted discount rate. That's what we traditionally used it, but it is not allowed here. So they have to be very explicit, even though I mention it. So in terms of structure itself, it's gonna be composed of four different parts for the insurance contract. Building block one is an estimate of future cash flow, and the feature itself, one most important thing is unbiased, and another one is explicit. So that is the expected value and probability weighted mean. So I'm gonna go into the detail in another presentation, but anyway, that's the building block one. Here is number one, and second one is discount rate, but the standard says is an adjusted value to reflect the time value of the money and the financial risk. Excuse me, to the extent that building block one is not it is not biased, and this one should be market consistent. It shouldn't be not entity specific. So for example, if you have a, let's say, investment results like higher than the other competitor, you cannot use it. This is should be based on the market. And building block 3, risk adjustment, is a new one for non-financial risk. So it means that we have to reflect. So this is another adjusted value to reflect the uncertainty of future cash flows. So this is a very quite natural quantification of the cash flow uncertainty. And all those three, building block 1, 2, 3, can consist, can be could be fulfillment cash flow. It means that all those three components are combined together is to fulfill the contractual legal obligation, and also it is the criterion in the honors test. I'm going to explain later on. And building block 4 is another new concept, is a contractual service margin. I'm going to show you later in an Excel examples. And this is a very simple diagram provided by insurance actuarial note published by IAA. So what makes the IFRS 7 be an actuarial paradigm shift? This is, like some of the key features, new concept that I think the, like all of the reasons why. The level of aggregation. And it clearly says that we don't measure in individual contract because, like our business is based on the law of large number. So we are gonna measure, recognize, and measure the insurance contract on a level of group of contract that has to be defined in the standard itself. And also it is unbiased estimate. Yeah, as I already mentioned, it is the most important feature, future cash flow estimate. And traditionally, we have been long used just, calculate the point estimate, let's say, like for example, life insurance, you have a face amount times and, like probability. And then that's the future prediction. And that's inevitable. We cannot do otherwise. But, like for IFRS 17 standards suggest that, distribution estimate. And also the measuring time horizon, framework. It means that previously we just price the contract and that's permanent. So we just, like keep evaluating, for example, all the reserves, like especially for that premium reserve, we just use whatever the assumptions when we price them. But IFRS 17, as time goes by, you have to be based on whatever the current at the time, right? So it keeps changing. So that's another factor. That's why, IFRS 17 measurement is composed of two different parts: measurement on initial recognition and subsequent measurement. Because, all the assumptions and parameters could change. And also, you have to look back and what is the difference between your estimate and uh, probably, the actual value. There is the experience adjustment. And also, like, in subsequent measurement, you have to estimate the fulfillment cash flow for the future remaining coverage again. And if there is any change on a current basis, we call it just estimate adjustment. And also one of the, most important or, like complicating part is that uh, treating of contractual service margin and loss component. I'll explain it in detail later on, but this one is probably the just, like a future unearned profit out of the fulfillment cash flow, and this is a loss component for owner's group of contract, and this one is treated differently. This asymmetry between CSM and LC, and then we recognize it as a profit or loss, is quite different. This is creates a lot of like complicating issues. And another feature is that CSM is a, let's say, visual account. You can see it as a value, let's say, in a balance sheet. But loss component, you cannot see it in a, you know, like a balance sheet or elsewhere. You can see it in a PL statement, and this one could be the loss recognized immediately from the new contract. So we will say invisible or shadow account. And also there's some very, technical issues. Allocate. CSM should be allocated all the way down to the contract boundary, and loss component has to be reversed all the way down to contract boundary. And also risk adjustment could be like allocated mm, in contract boundary or the remaining service period. So I'm gonna mention it detail later on. So the measurement itself has like two part. First of all, measurement on initial recognition. Let's say we have a new contracts coming in and you have to measure it right away. Practically you're gonna do it probably on a monthly basis at the end of month, but theoretically, principally, the IFRS 17 standards says that you have to measure it immediately. And then um, we do the onerous test of set of contract, right? In the standards, in the like onerous group of contract section, it used the term set of contract. So this is quite arbitrary. I wouldn't say just like pick up any random like set of contract. Probably based on historical data, you just do the analysis using based on the all the rating variable or underwriting variable, and you just have a set of contract and you do test on those set of contract. And like some of the other like necessary measures. But once you are, let's say, convinced that this set of contract belongs to one group, and now based on the onerous test, now it is the group of contract. Once you have like let's say the specify the group contract, you have to create the like a policy number. There's a group ID number, and it's gonna go forever until all the contracts are derecognized or expired. Anyway, let's have a look at, based on onerous tests, how we can create the non onerous group of contract. So first of all, you have an actuarial model working on. You have already implemented it, and like it's working, and you measure building block 1 to 3, which is the fulfillment cash flow. And if it is a non-onerous group of contract, you're going to have a building block 4, contractual service margin. And the way how we define CSM is that like when you measure it immediately after it is recognized, that insurance contract liability is zero. And also, there is an onerous test, it meaning that like fulfillment cash flow is a negative. That means it is a net inflow, and that amount, the negative amount, you change the sign plus, and then that amount is gonna be the initial contractual service margin. Or in case of onerous group of contract, let's say building block 1, building block 2, building block 3, and this fulfillment cash flow shows net outflow, means that bigger than zero, then this amount is going to be recognized as a loss immediately. Yeah, it says immediately, meaning like first reporting period, quarterly or annually, whatever. And then you also set up the liability for remaining coverage loss component side. So I'm going to show the example, but onerous test is going to give you an ability to distinguish non-onerous or onerous group of contract, and then we measure it based on that. This is the measurement on initial recognition, and CSM could be estimated or calculated, no otherwise. This is the only time on initial recognition you can come up with the CSM or loss component on the initial recognition. And later on we just like add or subtract out of it as time goes by. That's how the like initial the measurement works. And second part is subsequent measurement. And once you look at the time diagram here, I started at 0 and then time passed, so I am now at t, and we have to do another measurement. It is called subsequent measurement, and you have to do measure again for the remaining, like the contract boundary side period. And for the non-onerous group of contract, they say from time 0t, there is an estimate on an initial recognition. You put it on, and there must be an actual value, and also building block 3, risk adjustment. But risk adjustment is just a like quantified amount for, let's say, uncertainty. There is no experience adjustment. And then let's say like some of the claims already occurred here, and we need to estimate future like cash flows, and that has to be estimated probably based on this one. And here, like a future cash flow, and there is another one, discount difference. So let's say that should be recognized as a profit or loss in the PL statement right away. But in case of building block 2 is a little bit different, because that is, I already mentioned, it is a market consistent, so that's not entity specific. Frankly speaking, it's not your fault, right? So if something changes, it's not recognized as profit or loss right away, and you have an option to put it into like other comprehensive income. So that is a difference. And also there is another like exception, is that the premium is defined by upfront like payment of money to guarantee that if something happens in the future, unexpected event occurs, and I'm gonna be compensated. So it's always like future prospective. So that one doesn't belong to experience adjustment. That's gonna be like reflected on contractual service margin. That's the only exception. That is it. And also we have to do again measure the future. So again, this is what I have done on an initial recognition period between T and N. There's a fulfillment cash flow, and then right now on time T, I measure again for the period between T and N, and there might be like difference. And that one, all the like building block component 1 to 3 all combined together, and if it is a net inflow, it should be added onto CSM net outflow, and we have to subtract it from CSM. And for example, extreme case, net outflow is bigger than the CSM, right? Already existing CSM, here is an initial recognition, and then CSM becomes 0, right? And the remaining amount is going to be set up as an loss component at T time, and this non-onerous group of contract is converted to onerous group of contract, right? So I briefly explained, that's the estimate adjustment. And same, subsequent measurement for the onerous group of contract. Yeah, the experience of adjustment works the same way, right? Between 0 and t, what's the difference between estimate and actual? And RA is an exception. So it's the same story, right? You can put, like building block 2 difference into the other comprehensive income as well. That's the experience adjustment is pretty much the same, and estimate adjustment is different. This is I want to call it, like, subsequent measurement. Oh, unlike the initial, like a measurement, our liability is to be, let's say, separated into like liability for remaining coverage and liability for incurred claims. And also for the onerous group of contract, as I indicated on an onerous test section, there is a non-loss component at RC. In this case, we apply the estimate adjustment accordingly. So time between t and n, and like if there's a change, we put it into like, but here onerous group of contracts, so there is no CSM. So if is a net inflow, and then we subtract from loss component. So loss component has been like decreasing. Net outflow, we have to add that outflow amount onto the existing loss component. And what if net inflow is bigger than loss component at the time t, and this onerous group of contract turns into the non-onerous group of contract, and at that time the difference amount is set up as a CSMT, right? So it's vice versa. And there is the remaining, let's say the loss component, liability for remaining coverage, and this is the one, right? As I already explained it here, it has to be reduced or like or increased by estimate adjustment. But if it's not the case, you have to normally, the loss component is recognized as a loss on initial recognition. So here, let's say, you know like from uh, time 0 and t, you provide your, let's say, policyholder with insurance service, and you get the reward, right? That's going to be turned into like insurance revenue, and out of that portion you have to allocate between loss component and non-loss component RC, and then allocated portion to loss component could be subtracted from LC loss component 0. So that's how we prevent the double recognition of future expected loss. So that's why it says the loss component reverser. It it arises because of asymmetry between CSM and loss component. Obviously, like net inflow is bigger than the initial or existing loss component, and it all becomes 0, and then we set up the contractor service margin at t, right? I know this is quite complicating, so I'll show it to the Excel right now and give an example. And first of all, let's start with the measurement and initial recognition. And here is what I have summarized, like fact pattern. And this is what ISB used instead of, like some of the assumptions. So we assume, let's say here 100, individual contract altogether, and we already done the onerous test to distinguish non-onerous group of contract and onerous group of contract, but they have the same, let's say, single premium paid, and the annual paid claim is 200 for non-onerous, 400 for onerous, and insurance coverage period is 3 years. So which is very simple and easy to understand how it works. So some people say we don't have such cases. Yeah, obviously this is just a fact pattern, okay? And we just gonna show, like, demonstrate how the measurement works. And initial recognition, I just decompose this different side. Building block 1, cash inflow. Building block 1, like a outflow. And building block 2, inflow. Building block 2, outflow. As you see it, you can just come up with a very simple, let's say, calculation based on it. So it's just discounted building block 2, and building block 2, inflow is because we paid a single premium, so no value in it. And the RA figure for non-onerous and onerous, the same, 120. Yeah, I mean, this 120 should have been bigger, but this one is, like, make it as simple as possible just to weigh how it works. And for the non-onerous group of contract, if I add those up, I have a fulfillment cash flow. There is a negative value. So I would say this is a onerous test. So this could be a non-onerous group of contract. And that number, we change the sign and same amount and put it into a, let's say, initial contractual service margin, which is the same value. So if you just add those up, it becomes 0. So it means that for the non-onerous group of contract, the insurance like contract liability is 0 because we made it so. But on the other hand, onerous group of contract, you have 309 positive, which is a net outflow, and minus means net inflow, and in this case contractual service margin is 0. So if we add those up, we have the number 309, and that's gonna be the loss component. So it should be recognized as a loss immediately, let's say on the first reporting time, and then set up as a loss component, like LRC, later on. So I'm giving you a very interesting, like, the example for another one. What if I say you received the single premium 900, and we are gonna have let's say like immediately after the reception of premium, we do the subsequent measurement in this case, right? So this is pretty much like theoretical. Now it could be possible, right? But in this case, you can notice that there is only change for single premium, right? 0. Because you already paid a premium, and for the remaining coverage period, there is no way for another premium coming in. But the other building block 2, cash outflow, or the other one, look all the same. So this is one of the extreme example of subsequent measurement, and you have let's say 900 as a contract liability for non-onerous, and onerous 1209, which is a sum of 900 single premium plus loss component. What it means is that for the non-onerous group of contract, you can use all single premium 900 could be, let's say, allocated. But for the, let's say, for the onerous group of contract, you cannot use premium allocation approach out of total 900 because you let go of your you know let's say the insurance contract liability obligation because you far off, let's say, by the amount 309, which is a loss component, right? So that's how the initial measurement works. And then another simple example is for the non-onerous group of contract. So let's say do the subsequent measurement. This one shows, first of all, Exhibit 101 in the disclosure. Let's say, when it shows the example, it always, let's say, the initial recognition measurement is the same as before. And let's say at the end of year one, you have to measure again for the remaining 2 year, right? So you can have, oh sorry, this is Korean, but anyway, like 200 200 at the end of year one, so you discount it, so 372. And this one is another 200 on the third year, discounted 190. And all the other one I'm gonna explain later. The exhibit 101 is, let's say, organized in this way. This one is, sum of building block 1 2, and this one is risk adjustment, which is a building block 3, and CSM for non-onerous group of contract. So when it does is that, right from the opening balance to closing balance, you start with the all zeros, obviously, and then you measure on initial recognition all those. So this is a, when you look at it, for the all future, like contract boundary 3 years, how did I come up with like estimate? So building block 1 2 3 and CSM here 235. We start from there, and then we follow the cash transaction. So 900 as a single premium added on, and if I add those two, and there's an insurance finance expense, the interest rate that you use, the discount is like 5%, and then changes related to current service is an experience adjustment. So we assume annually 200 paid claims, and actually 200 paid. So there is no experience adjustment for the cash outflow, right? Premium, there's nothing to do with that here. Single premium, if there is something, as I mentioned it, that difference is going to be reflected in the CSM anyway. And also RA has to be allocated for the total 3 years, and standard says it has to be based on risk released pattern. That risk means insurance risk for the specific type of coverage, and this one is simply like, because it's 120 40 each year. So this one means that this is an estimate, the experience adjustment. But for the RA and CSM, it means during this time, year one, I provide the policyholder with the insurance service, the coverage. So, I'm going to be compensated for allocated portion. CSM is also allocated out of total contract boundary. So let's say 3 years. And here example just like simply divided by 3, but the standard says it has to be based on the benefit amount and remaining period, which is like principal, right? But in practically, this is another issue, that how we can, come up with the allocation, because it's very critical. That's going to be determined in year one, profit level. So right now in Korea, there is a, like big, huge, very serious debate on it, right? And you don't change it. This could be another section that, could arise of the, like, fraudulent, manipulation. Anyway, here just using 3 year, and we just use the, like inter-theory function to come up with the 82. It means that these two value added together, that is 122, is going to be recognized as a profit during the year one, right? That's how it works. And if you just simply the sum of those series of numbers, closing balance is like this. So building block 1, 2, 3, 4, and you have a 617 on the year one. And when you do like a like measure again at the end of year one, you added those two, and obviously CSM is like, let's say there is a insurance finance expense, and add it on, and I have used like just simply divided by 3, and remaining is 160. If I add that, and you have to come up with the same number here, that's one like reconciliation point. And you can just like to easily understand how it works for the second year and third year, unless you have a change any, like estimate of future cash outflow and actual payment. You have to remember, like experience adjustment here is that it doesn't include the discount number, just like cash outflow, the absolute dollar figure. And let's assume that on a second year, let's say there is a 2A, on a second year, there is a case that when the future, like let's say claims paid amount has reduced, because year one is the same, right? As you recall it, the same. But second year, for somehow, we estimate, let's say 200 as a cash outflow, and actually we paid out 150, right? This one, 150. So you can either, let's say like don't change any assumption, but you believe that this is a, let's say, permanent change. So year end 2, you come up with, instead of 200 in the third year, it says, oh, 150, right? That based on actual payment. So it says, there is a, like fulfillment cash flow changes that increase future profitability, meaning that, let's go through, all the other is the same, and then you have here, like future service means you change the, you know let's say future estimate building block 1, 2, 3, you know differently, because you have a, like less claim outgo. So that comes with 57 for building block 1, 2, and risk adjustment in also, you change to, let's say here, you know 30 instead of 40. So you have a 10 less. But this one has to be, let's say, added onto existing CSM, right? But when this happens, we just apply the insurance finance expense on the, before, not after, like, CSM. So that has to be added onto CSM. and then you just divide it by 2, right? And on the CSM itself, let's say you allocate the initial, let's say, CSM for, let's say, 3 years, and even though 1 year passed, and you don't just recognize your allocated CSM right away, you have to look at the estimate adjustment. So if there is any changed value added on or subtract on the existing CSM, and you have to reflect that first and then recognize it as a like profit. So year end 2 is increased this because we changed the assumption. And also there is a experience adjustment. The difference 50 is a profit that we recognize it right away, because we assume 200 as a claim outgo, but there is a 150 that actual payment. And unlike the example 2, this one, one reason experience adjustment, the second one we changed the future assumption, we have this one. And RA40 is already allocated. Unlike CSM, you have to just stick to whatever you allocated. So 40, and then add 67 onto the existing CSM and divide by 2, 120. So this one is increased a lot. And third year, actually you assume 150, but there is a 140. But this is a end year, so we don't do it like this. But anyhow, you have to come up with all summation, and all has to be 0 later on. And if you summarize it into the brief, let's say the BSPL, here it looks. You can compare these results like this, right? First year obviously the same, and there is a 100 and 117 versus 183, 143, right? That's what makes the difference. So actual payment is reduced and you change the assumption. But there is another, let's say, even though that happens, I don't change the future estimate. This is just like temporary, so I don't want to change the assumption. But still, experience adjustment produces 50 as a profit. But here nothing changes, because like future fulfillment cash flow for the LRC isn't changed at all, so all 0. And let's say like third year, as we estimated, 200 paid, and that produces something like this. Or if like if I make the same like this, and like this one is, it produces like this. Okay, and you can compare something like this. First year is the same, but second year 183 and 150. That's what the differences makes. If you, let's say, change the assumption, or if you don't change the assumption, that's the difference. Okay. And second example is that any fulfillment cash flow changes that creates, that turns into the owner's group of contract. Let's say year 1 is the same as before. Second year, actual payment results in, let's say, 400 instead of 200. In that case, you change the third year assumption, and also experience adjustment is difference 200, we have to recognize it as a loss, right? And that one, and also we change the third year assumption. Let's say, because it the claim out go 400, so I assume that third year instead of 200 probably 450, and then risk adjustment allocated risk adjustment for third year is 40, but I raise up to 88, and it means the difference is 238 and 48, right? And that has to be subtracted from the existing CSM and insurance finance expense. And this is much bigger, right? This outflow. So that one is all, eat up the CSM value, and then there is a, later I show you that loss component is set up for year two, and it all, like it's up. And this one is, actual paid is same as what we have estimated and something like this. And we have this. In this case, we can have also, even though there is a, second year 400 actual payment, but I don't change the future assumption because you think it is, temporary, and it means that you don't have this 0 0, only the experience adjustment. So it means that it is not going to turn into onerous group of contract. So you have a, like the profit recognition out of CSM as well. So this is a very important feature. Let's say, even though, let's say 1 year result shows the like significant difference, right? 2 times like more money went out. But even so, this one is temporary, so you don't change assumption, it remains as non-onerous. If you change it, it turns into onerous group of contract. That is quite, important message here. And all the auditor or actuarial validation is gonna probably look into it, put a, like surveillance camera on it. And this one is based on, let's say, exhibit 101, and I can simply go through, let's say, uh, summarize it into exhibit 100. So this one is says liability for remaining coverage. This one is LRC, we used to say, and this is liability for incurred claims, LIC, decomposed into like, two different parts. But anyhow, yeah, this one has to be the same as, exhibit 101, and NDR 2 is the same and the same. And out of that, I, like make the summary of BSPL here, and this one I got it from the example 2 here, right? I just simply get it, and it has to be reconciled, right? So each and every group of contract, you must have it in terms of, let's say actuarial like actuarial, process behind it. But, standard says, like you can just disclose it for all portfolios, right? It has reduced the number of, let's say, exhibits in your financial statement. But in terms of actual practice, you have to have all the, this exhibit 101 and 100 for each and every group of contract. Anyway, this is a very good part. And for the, scenario that the fulfillment cash flow change that increases future profitability, it also has, LRC, LIC accordingly. This one should, like reconcile each other. This one comes from exhibit 101, and this is 100. That has to match exactly. And here is a serious, like problem. Let's say, year two, year one is the same, but year two, because we change the future assumption. Let's say your future is only, like a third year, but still, it creates. Do you remember 113? So if I go back, it's to A, year two. Okay, here we go. Where is it? Where was I? Sorry, year the 2B, right? And here, because you change the future assumption for year 3, that creates the, like bigger outflow number, so it, eats up all the remaining CSM value, and leftover is 113. And that's gonna be the, like loss component LRC. So at the year, let's say at the end of year two, suddenly this non-group of contract, non-onerous group of contract turns into the onerous group of contract, and the loss component here, year two is 113. Right? This one is recognized as a loss right away and still remains. But this happens, at the end of year two, so it's kind of, let's say, lucky. And I don't know, I might be able to show, another case, but in this case, as I already mentioned, like loss component reverser is not as easy as it looks. Yeah, I quickly explain it. So when you have a, let's say, loss component LRC, it's quite different. If it doesn't exist, it's quite simple, but here 113, you have to reverse it, right? It doesn't, just automatically does it. So here, let's say, what the standard says is that you have to allocate insurance finance expense first. So this is not added up. It's 25 is comes from, no. This one is, like example 2BF 160. Here is a, like insurance finance expense there. And this figure is like the previous one. I mean, out of, total, let's say total 517, and it is decomposed into here, right? So you can get the allocation ratio here, and this one is just, the other side. So 21 is decomposed into that portion, and 78.1, so it add up to 21, right? And once you have done that, we are gonna allocate the, let's say, building block 1 2 3, estimate portion for, let's say, year 3, because this one is going to be recognized as a, let's say, insurance revenue. And in order to allocate between loss component LRC or non-loss component LRC, here, a little bit like complicating. So in the, in the numerator, just, like your portion, I mean insurance finance expense, and also the opening loss component. Okay, but on the denominator, you have to add total, like 515 and 21. You have to subtract the investment component. This is the new one actually in year 2020 versus year 2017. And you have a slightly different allocation ratio, and Once I do that, this one has to be, you know, allocated like this. Right? Total 350 is like this, and also RA is allocated 24 and 64. So if you add up, this 118 goes here to reverse the loss component that we already recognize it as a loss. And there is a insurance finance expense and becomes a zero. You have to be do the reconciliation like this. And the other rest is going to this portion to make it zero, right? And this one looks very easy, but it's very complicating because standard itself says that, let's say, has to be allocated in a reasonable way. I don't know exact expression, but like reasonably allocated. It doesn't give you any specific figures, but in an illustrative examples, there is a, let's say, figure change, and even you know like let's say year 2020, they amend the allocation ratio accordingly. And this is what most people are confused about, like loss component reversal and allocation between like loss component RRC and non-loss component RRC. And do you know how it is, like complicating to build up the actuarial process itself and put it into, somewhere the data field component? So it's not as easy as it looks. And out of this exhibit, let's say 100, you come up with the summary of BSPL. And I got it from exhibit 101 that had to that has to be like matched accordingly. So it means that allocation of like loss component RRC and non-loss component RRC works well, and that has should be organized into the whatever measurement result database. So this is where the most Korean insurance companies, made a mistake, and they don't like correct it up to this point now. So this is the example of, let's say, the measurement on a high level in the IFRS 17 standards, and I just give a little bit of detail. But this exhibit 100 and 101 is to be required to disclose. When you go into the disclosure section, that has a lot of list, right? It does include some of this type of very quantitative exhibit, but qualitative statement is required to disclose. So you cannot just like play around it, and otherwise you're gonna get a discredit, right? So this is probably most people ignore, or they have missed this very important, let's say, standard principle. Okay, this is it, and I wish I could do like more, let's say, example explanation. And I know in the real world it's gonna be much more complicating, but you have to do the reconciliation based on exhibit 100 and 101 anyhow. Otherwise you don't know what kind of like numbers in the financial statement, and you're not sure about your results at all. Yeah, this is the end of my session, and thank you very much.